Good afternoon, everyone, and welcome to the Allan Small Financial Show. Thank you for taking some time out of your busy day and joining and spending some time with us and joining us today. Over the last few weeks since we got together, the last time we were on the show with Dan Kelly, markets have been extremely volatile, to say the least, causing investors and people in general a lot of anxiety. And we do this show every 2 weeks to hopefully bring some information to all of you so that that anxiety becomes a little less. As I always say, knowledge is power. Understanding why the markets are behaving the way they are, I believe, will help everybody get through these more volatile times. We also like to bring in some guests, as I mentioned, Dan Kelly, Patty Lovett-Reed, Jonathan Chevreau, some of the guests we've had over the last few months to give us their perspective on things, to, I guess, give another voice to the conversation, not just my voice, but voices of some of these individuals that have been in the economics world or the investment world for many, many years. And these people are very smart. They come with a different perspective than myself. And I always like to provide a different point of view. So this is why we do the show every 2 weeks, to help you, the investor, and to provide the answers that you're looking for. As I say often, if you have any questions, any comments that you'd like to make during the show, please put it into the little box, YouTube or Facebook Live. I'd love to be able to answer the questions that you have. If you have any questions after the show, if you're looking at the show again as a post, a review, or if you happen to be late to the show and watch it after the fact and you have some questions, send me a message. Send me a quick email. Definitely would be able to answer those messages and emails and provide some feedback as to what's going on with your investments or the markets in general. So without further ado, let's get on with the show. So on today's show, we have a number of topics I want to touch on. The first one's kind of interesting. We called it surprise. The markets are virtually the same as they were on June 30th. Getting a lot of calls lately, a lot of investors receiving their September statements, investors noticing that September was a really poor month, and they're concerned. But we're going to talk a bit about how the markets really haven't moved much in the last 4 months. We'll also go to our this week components. This is where we discuss what I believe is important for individual investors to consider before they make their investment decisions over the next few weeks. Will the October rally continue? We've seen a huge rally in the markets for the month of October so far. Obviously, the month has still a few days left. The Dow Jones actually is up over 10% for the month of October. Will this rally continue? And lastly, are the markets a good indicator for the future as to where things are going, where the economy is going? Will the markets be able to tell us how things will be 6-12 months down the road? I believe you all know the answer, and the answer is yes. Markets are a great indicator, forward-looking indicator as to where things are going. And finally, I'm going to take your questions. Any questions that you have regarding your own personal situation, any general questions on the markets, perhaps something you saw on TV, read online, be here happy to answer those questions for you today, and I'll try and get to as many questions as I can. So as I indicated, when you look at the general markets, and I'm talking about North American markets now, whether you look at the TSX, whether you look at the Dow Jones, the NASDAQ, the S&P 500, which I look at the most, S&P 500, largest index in North America, provides us a good look at 500 companies in the United States and how they're doing and the ups and downs of those names. When you look at these indices or the markets in general, you're going to notice that coming into this week, and they really haven't changed much since the beginning of the summer. It was kind of funny. I looked at the TSX, and the TSX was almost identical in terms of their points, where they were trading at, roughly around 18,870, 18,670 in that range, almost identical to where the TSX was trading at the start of this week. This week has been a fantastic week, so that these indices now are actually, some of them are trading above where they were trading on June the 30th. And we have a few charts that will clearly show this. One of them, the S&P 500, we can pull that one up. You'll notice that if you take a line towards the bottom there, you'll see June, where the market or the S&P was trading. See how low it got to in September. And the rally we've seen in October has pretty much taken the indices back to where they were and now above where it was, I guess, July 1st or beginning of summer. If you take a look at the TSX, you're going to notice the same thing. And even investors and all the investors that are watching the show today, take a look at your portfolio. Go back to where the portfolio ended the month of June. Where was your portfolio back then? I noticed some of my investors that I had a chance to look at over the last few days, and many of them were pretty much back to their June 30th levels. Now, yes, June 30th was a lot lower than where the market started the year, but for those that have been feeling very negative, for those that have been feeling that the market just seemed to keep falling after, especially after you saw your September statements, where September was one of the worst months we've seen in a long time, I think this is maybe cause for a little optimism. I've said for a little while now that I believe the markets could have a positive second half to the year. And for a little while there, I probably thought, or many of you probably thought, that I was a little going crazy, that there was just no way these markets could show a positive number from July to the end of December. Well, here we are, almost the end of October, and that's exactly what we're seeing. We're seeing markets back at the flat line to slightly positive after a pretty good October. And hopefully we can end the month of October on a good note. If you look at some of the seasonal factors at play, September is usually the worst month of the year. August or September tend to be the two, months of the year where we see very weak markets. October tends to be transitional. We come into the month on a low note and end the month on a bit of a high. And then when you get into November, December, those are two of the best months of the year for investors. You get a lot of Christmas and holiday shopping, US Thanksgiving as well is in that period of time. And people are just in good spirits and they tend to spend money. We'll see what happens this year as interest rates may play, higher interest rates may play a bit of a negative in what the consumer spends. But having said that, I'm actually looking forward to the next couple of months. I believe if the Federal Reserve and Bank of Canada can tell us, or at least maybe give a bit of a hint, that the higher interest rates or the interest rate hikes will start to slow down, maybe not raise as much or as quickly, I think we could definitely see a positive to the end of the year. And the second half of the year will be positive. Yes, it may not be enough to make back all the losses or the negativity of the first half of the year, but at least we can head into 2023 on a positive note. So for all of you watching the show today, keep this in mind, that things are not as bad as they may seem, that we really haven't gone anywhere to the downside really since the end of June. And hopefully over the next few months, we can regain some of the losses that we experienced in the first half of this year as we head into a new year, 2023. So this is the part of the show where I talk about what I believe is important for individual investors to consider over the next few weeks when you make your investment decisions. I know a lot of people recently aren't making many investment decisions. Speaking to a few clients, they're very reluctant to put money to work at this time, but I think that could be a mistake. I think it takes an iron stomach to be making some investment decisions when everybody else seems to be fearful. But as we all know, and as I've said many times on the show, that's probably the best time to be looking at making some good investment decisions. So what are the three topics this week that I think individual investors should focus on? First, economic data. I talk about economic data all the time because the markets are moving on it. Inflation data. We saw recently Canadian inflation down to 6.9%, down from about 8% that we saw at peak. US inflation down to about 8% from over 9% we saw at the peak. We also want to focus on what the consumer is doing. Are they still spending? What's their sentiment? Are they more negative, more pessimistic? The answer is yes. We've seen consumer sentiment numbers, the lowest we've seen in quite some time. The consumer is pessimistic. They believe that there is a greater than a 50-50 chance that we will be in a recession come the first half of 2023. And even comments by the Bank of Canada as early as or most recently as this morning, telling us that there's a decent chance we could see a mild recession or definitely a slowdown in the first half of 2023 based on the number of rate hikes that we've seen in 2022. So economic data is going to play a big factor. And I think we have a chart which shows a bit of the data, inflation, interest rate hikes in the same chart. If you want to put that one up, there it is. And you can see September 2022, 6.9% is the inflation rate. You can see excluding food and energy, obviously lower, but still almost approaching 6%. I think the Bank of Canada said this morning that anything we've seen, that reduction from 8 to 6.9 really is because of lower oil prices. Pretty much food prices still remain high. You can see here in this chart, the overnight interest rate versus the inflation rate, how much interest rates have gone higher. And yes, the inflation rate has ticked down because of that. I think we have one last chart there on food prices, and you can see how much food prices have gone up. Food prices rose 11.4% year over year in September, which is huge. Cereal, coffee, non-alcoholic drinks, etc. These are staggering numbers, and we're not alone, right? We continue to see inflation as an issue down south, wage inflation, food inflation. So I guess the central banks, they're in agreement that we're seeing a softness in the economy, and that is definitely helping inflation tick down. But they still believe that most of that inflation dropping is due to lower oil prices. So we need to keep an eye on economic data, future interest rates. And I think that's going to lead us or give us a good indication as to the path for the stock market. The second point I think individual investors should focus on are corporate earnings. We're right in the heart of US corporate earnings. We've just, scratched the surface or just started the Canadian corporate earnings season. CN Rail just reported earnings over the last 24 hours, and their earnings came in really, really good. They actually took up their expectations going forward. So CN Rail is telling us that they're still shipping everything from grains to oil to you name it on their trains. And that's a great sign. That tells us that the economy is still moving forward. But there are a lot of corporations, especially in the US, that have disappointed us. Most recently, last night, we saw Alphabet, formerly known as Google, disappoint all of us. And they did not meet the expectation. They talk about a slowdown in advertising spending. We heard from Snap. We're going to hear from Meta, formerly known as Facebook, tomorrow, actually today after the bell, and we'll see what they say. Obviously, the Metas or the Facebooks of the world, the Alphabets, the Snaps, these are companies that really depend on businesses, small businesses, large businesses, spending money to grow their business. And we're seeing a definite slowdown in Google or Alphabet, and we'll see what Meta, there's a chart of Meta there, down almost 60% this year alone in their stock price. Lastly, we heard from Microsoft last night. They actually beat on both the top line growth, revenue growth, and bottom line growth once you factor in all their expenses. Yet Microsoft is down also 5% today because we saw a big part of their business, which is the cloud business. Some of you may have heard of everything's in the cloud these days. Nothing is on servers. It's all up in the cloud. And their cloud business has definitely slowed. Azure is definitely slowed. I guess the main message we're getting from a lot of these corporations is things are slowing down. There is no doubt about that. A lot of businesses are talking about slowing profits, slowing profitability. But at the same time, it's not as bad as many had feared. So not as bad as it could be, yet slowing growth. And as an investor, I think you want to parse through a lot of these corporations before you make your investment decisions to figure out which one of these names is going to be worth it to buy. A lot of these names are down 20, 30+%. Which ones do you want to buy on the cheap? Which ones make sense? And which ones will be higher 6, 12, 18 months from now? The last, topic that I think individual investors should focus on before they make their investment decisions is overall portfolio or asset mix. And what I mean about that by that is the asset mix in your portfolio. For the longest time, we talked about TINA. There is no alternative, which is what TINA stands for. I talked about it on this show that if you wanted to get ahead, you had to invest in the stock market. There was no alternative to the stock market. Yields on bonds and GICs were 1%, if that. Well, today, those same products that were maybe 1%, 2% are now paying 4 or 5%, even closer, maybe closer to 5% than 4%. So you could buy a good quality corporate bond and it could yield for you just under 5%. Now, when you look at where the inflation rate is in this country, 6.9, or just let's say roughly 7, you're still not keeping up with the rising costs. Looking back, in my career, the last time I sold a GIC somewhere in 1999, yes, a long time ago, 22 years ago, that was when GICs for 1 year were 6.25, and the inflation rate was somewhere around 2.5%, 3%. So you could actually get ahead by owning some of these ideas, fixed products, GICs in particular. And really, since then, I haven't been a big proponent of GICs. Flexibility is an issue. Getting out when you want, you obviously can't. You have to wait till the GIC matures. And if you look back in history, there have been very few periods of time where GICs actually make individual investors money after you factor in taxes and inflation. So not a great option. However, today, bonds paying closer to 5, GICs are an option. And why are they an option? For the safer part or the low risk part of a portfolio. So if you were to do a classic 50-50 split or 60-40 split, 60 equities or the stock market investing, or 50% in the stock market and 40 or 50% outside, you could count on now a 5% or almost 5% rate of return on your low risk money, and then perhaps maybe a 10, 12% on your medium risk or equity component of your portfolio. And if you average the two, perhaps you're coming somewhere in and around 8%. So portfolio mix is really important. And you can see here, this is just an example of a portfolio mix for someone who's retired. Perhaps you want 50% in fixed income, and then the other 50% is scattered amongst other asset classes. One thing I will say before we leave this topic is understand and have the right expectations regarding fixed income. Understand the opportunity cost, perhaps. And there is an opportunity cost. If you are going to buy a bond or GIC, and it's a 1, 2, or 3 year or greater investment, greater term investment, longer term investment, what is the opportunity cost? Well, if you were to go into the equity market today or the stock market, and let's say you were to choose a simple investment, shares of Bank of Nova Scotia. Well, Bank of Nova Scotia today pays over a 6% dividend yield, and that stock is down by roughly 30% from its highs. So would you want to choose investing in Scotia Bank? The yields are higher than the yields you're going to get on a 1 year bond or GIC. Plus, you have potential to perhaps see a rebound in that stock. Now, maybe you don't see all 30% in a given year, but maybe you make back half. Very possible. We've seen markets jump when things are good. So what is the opportunity cost from parking money? A lot of clients or investors I've talked to recently, they're a little nervous about putting more money to work. They want to see things hit bottom. Well, unfortunately, we just don't know when things will hit bottom. And if you wait for that bottom, you may miss out on an opportunity. But if you were to invest in the market today and that investment then goes down, we still can be confident that you own a good quality investment. Eventually, that investment will rise and you will see the returns. But if you don't get involved or invest in the market, you could miss out. So even if you're in early and don't wait to see that bottom, which nobody can foresee, trying to time a bottom of a market is impossible. But if you get in too early in the market falls, stay patient. That market's going to rebound at some point. So at some point, if it's a good quality investment, like the Scotiabank stock, for example, I think you will realize the gains that are coming to you and that you anticipated and expect when you bought that stock. So understand the asset mix that you have, understand that there are other opportunities to put your money into, but understand what they're going to do to your portfolio and how they're going to affect the returns of that portfolio. So will the rally in October continue? That is the question, I think, on the minds of individual investors right now. And I guess the simple answer is it's going to be up to the Federal Reserve, primarily, maybe a little bit the Bank of Canada. If they continue to raise rates aggressively, I know the Bank of Canada had their announcement today. Federal Reserve will have their announcement, I believe, November 2nd. If the Fed comes out and squashes everything by saying, we're going to keep raising rates aggressively no matter what it takes to bring down the inflation rate, then I think you're going to see the market sell off again. If the Fed shows more of a softer tone, more dovish tone, says we're seeing some good signs, inflation is falling, we're seeing a slowdown in many areas, real estate amongst others, manufacturing, etc. If he talks a bit of a softer tone, I think the markets are going to like it. I think 75 basis points hike is already priced in on November 2nd. But if they say perhaps maybe a 50 basis point hike is priced in December, so a little less than the 75 in November, I think the markets can rally. And as I said earlier in the show, I think it is very possible we have a positive second half to this year, positive fourth quarter, based on the holiday season, the Santa Claus rally, whatever you want to call it. I think it is very possible that the rally in October can continue, maybe not at this pace where the Dow is up 10.5% in a month, but I think it can continue. And a lot of it's going to fall on what the Federal Reserve says and I guess what the interest rate hike will be and the pace of hikes. And I guess a lot of Fed speak. It doesn't take a lot for this market to move. All you need is a Federal Reserve official to come out and say something negative or positive, and the market just goes up 300-400 points in a matter of minutes. And that's how jittery this market is, unfortunately, where one person can move the market that significantly. But that's the way it is right now. And we'll take what we have in October. We hope for a good closing over the next few days as we get closer to month end. And we cheer for some good earnings to come out. And we look forward to a good holiday season. So why did the markets go up April 2020, May 2020, June 2020, after we saw the biggest decline in such a short period of time in March 2020 due to COVID? We were all still pretty much locked down right across the globe. Here in Canada, we were all locked down. We were locked down for months. And the stock market was going higher. Businesses were shuttered. Some people went out of business. A lot of people had to rely on government subsidies. It was pretty doom and gloom. I was having conversations with investors, and many of them couldn't see the light at the end of the tunnel. They actually didn't think there was one. But yet the stock market rallied the second half of the year. Why? How could the stock market rally when business was virtually at a standstill? The answer is very simple. The market looks 6, 12, 18 months ahead. It always has and always will. The stock market is a fantastic forward-looking indicator. It's the best crystal ball that anybody could have. You shine up that crystal ball called the stock market, and you figure out what is going to happen in the economy based on what the stock market is doing. So back in 2020, stock market was telling all of us that things eventually would be okay. We would get vaccines. We all would go back to traveling, even though everybody was questioning, would you ever get on an airplane again and travel? Would you ever go to a movie theater and watch a movie? Well, tell that to the movie-going lovers that have packed into the movie theaters over the last year and a half or so. Or how about all the people that are trying to get on a plane to take that vacation that they missed 2 years ago? The economy has bounced back. People are back at their workplace of work. They're back going to restaurants, movies, hockey games. They're back traveling. And the stock market somehow, some way knew this and started to rally in anticipation. In 2021, when interest rates were still pretty much at zero and money was easy to come by, the stock market had a tremendous rally in 2021. So moving forward today, what is the stock market telling us, or what was it telling us earlier this year? Well, it was seeing the opposite, doom and gloom. Even though the Federal Reserve was saying inflation is transitory, it's temporary, stock market was telling us, it was not. And stock market, again, was correct. Bond market is also a very good forward-looking indicator. So when you see interest rates rise or fall, those are other indicators from the bond market that can tell us or give us some indication how things will be in the future. So going forward, when you see the stock market rally and you don't understand why that day, understand that it's probably rallying based on something in the future, forward-looking indicators, future potential. And I think that is really important. So when people ask me, how do you know, or how could you possibly predict that the second half of this year will be better than the first? Because I believe the stock market will rally at the end of this year based on what it sees in 2023, maybe not in the first half of 2023, but in the second half of 2023, once we get through any more interest rate hikes and perhaps some mild recession in Canada and in the United States. So look at the markets as a forward-looking indicator, a fortune teller, if you will, the best fortune teller that there is out there for all of us to know whether we should be putting our hard-earned money to work or we should be hesitant as we look forward to, with all our portfolios. So now the part of the show where I get to answer some questions from some of the viewers. What's my take, as we call it? Looking at, I guess we have some time for a bunch of questions here. So looking at one, what is the yearly amount you can put into a TFSA? What is the deadline? Is it a good idea to put money into a TFSA versus an RRSP? How do you decide which you should do? Great questions. I get that type of question often. TFSA versus RRSP. TFSA, tax-free savings account. RRSP, registered retirement savings plan. So the amount right now you can put into a TFSA on an annual basis is $6,000. However, if you haven't put money in previous years, that room gets carried forward. So if you haven't put in the last 5 years, you can add about $30,000 into your tax-free savings account. What is the deadline? Is it a good idea to put money into a TFSA? So it's on a calendar year basis. RRSPs is also calendar year, but RRSPs give you the first 60 days of the new year to be able to make a contribution. So until March 1st, and be able to use that contribution against the previous year's taxes. So this year coming up, you can make a contribution up until March 1st, 2023, and be able to write off that contribution into an RRSP against your taxes for 2022. TFSAs, there is no tax deduction for contributing. You put money in and your money just grows tax-free. When you pull it out, you don't pay any tax either. And I think tax-free savings accounts, now that the limits have gotten up to north of $80,000 per person, it's become a fantastic investment for many. If you don't need a tax deduction, many are choosing the TFSA over the RRSPs, because RRSPs, of course, when you pull money out, you have to pay income tax. TFSAs, you don't have to. So really the biggest positive for RRSPs, in my opinion, are for those that need a nice tax break every year. And that's really the main reason why people put money into an RRSP versus a TFSA. So I addressed that. Second question, if my portfolio is heavily weighted in banks and I am reliant on dividend payments for income, should I be worried now that we are heading into a recession and that the dividends may stop? Another great question. So I can tell you that in the history, or since we've been keeping track, Canadian banks have never suspended or reduced their dividends. So the only thing they've ever done is increase their dividends. And they usually increase their dividends a few times a year. Even, in times where they may not be the greatest. We tend to see banks still squeeze out a small dividend increase throughout the course of the year. We'll see over the next 12 months what they do. But you can rely on these dividends. So when a name like Scotia is paying over 6%, a name like CIBC over 5%, TD and Royal Bank over 4%, BMO over 4%, you can rest assured that if you're someone who is in need of income, these banks definitely fit the bill and will provide you with growth over the long term. I will try and take one more question as we're getting close to the half hour here. Are you able to talk about what you see as opportunities in the market right now? I think the market right now is cheap. Depending on how you want to analyze it, whether you want to look at the Toronto market, US markets, depending on what part of the market, there are a lot of parts of the market that are very cheap. I think you start with technology. If you can handle the volatility of a medium risk, you don't have to be in high risk, a medium risk tech stock, a big, large cap tech stock like an Amazon or Microsoft, who's down significantly today. Amazon reports earnings in, I think, tomorrow. Apple. These are the names I think you could start with. A lot of these names are down more than 30% from their highs. But technology in general, I think there are a lot of opportunities in technology right now, but there are a lot of opportunities in banks, financials, a lot of opportunities in retail. Even though pharmaceutical hasn't fallen as much as such as the tech sector, I think there are names in the pharmaceutical area that you could look on. So I just think overall, the market is very cheap. And I think, unlike maybe a year ago, I think right now it is a lot easier to build a nice diversified portfolio out of opportunities in the stock market than I guess in the last, call it, few years prior to this. Last year, the stock market was so red hot, it was tough to buy things when they're at new 52-week highs. A lot of these names today are at new 52-week lows. And as I said, if you have the iron stomach to buy when everyone else is selling, that is always, in my opinion, the recipe for success. I want to thank everybody for tuning in today to the show. I hope I shed some light on a few, I guess, ideas or questions that you may have. One thing I want to say is that in 2 weeks, we have obviously our next show, Wednesday, November, looks like the 9th, 12 noon. We're going to have a guest, Helen Hayes, on the show. She is managing director and head of iShares Canada for BlackRock. And we're going to pick her brain and see what she's seeing. BlackRock is one of the largest money managers, the largest money manager in the world today. They have their ETFs, the iShares, and we'll see where the money is going, whether it's flowing in bonds, out of bonds, into equities, out of equities. So it'll be a great show. So I hope you all can tune in, and we'll see you in 2 weeks, and happy investing.